I got a great question from a direct email from someone asking about, what's the most objective way to build, your trading system or your trading rules, your setups. And truth is like it's always subjective, right? Because you can look at Head and Shoulders, you can look at whatever type of chart pattern you want to look at, and some of them, are earmarked for being bullish. Some of them are supposed to be bearish. What I have found is that it doesn't always work out that way in real life. And ultimately, when it comes down to patterns, it's not so much the pattern, but it's how you trade the pattern. So that leads me to believe that all chart reading effectively is very subjective, despite what the chart pattern is supposed to be. I know people pump in, here's 12 bullish patterns, here's 12 bearish patterns. I always feel bad for the folks who see that because I think it's misleading. It's not the pattern, it's you. You're what matters here. You're the asset. I've said that before. Like, it's all about your behavior, not the chart pattern's behavior. You need to enter and add risk, then you need to protect your capital. You need to add risk, you need to protect your capital. See what I'm going here? You have buy stops above the market to add risk. You get filled immediately, you add protective stops because you have to protect your capital. That's very subjective behavior because it's all based on you and all your thoughts, feelings, and actions around making and losing money. How do you feel about risk? And that's intellectual, but what do you feel emotionally when you add risk, remove risk, and or have to manage risk? Because there's really three different parts. So, there's a saying, I don't know who came up with it, but, effectively all systems are discretionary. That's 100% truth because you're choosing all the inputs. You're choosing the quantity, you're choosing the position size, which to me is the most important thing, right? Because that's really how we make and lose our money is in position size. People focus on entries, which to me are somewhat important in that it is the go, no go kind of a deal of where you're adding the risk to your portfolio. But I have found over the years that my entries can be kind of super sloppy because my position sizing is phenomenal. And that's really, at the end of the day, what makes for the good horse race, right? You could have had a lot of people, for example, I'll give you an idea. Like when the market crashed in 87, I remember I was just at Wall Street a few years later, and everyone was talking about a particular analyst, a woman who had called the market. And I didn't know any better at the time because I kind of started with my journey in risk management around the same time the first Market Wizards came out. And I was like, wow, imagine to have that ability to kind of predict the crash. What I didn't know was that in the pro circuit, about 95 other guys, and perhaps women as well, were also very, very aware that the market was going to crack. And over the years, as I got to know them, know these people personally, and read about them as well, any of the pros, certainly the folks in Market Wizards, they were all short the market. Some of them were also short bonds. Some of them were also short the dollar, which is really what caused the break. I think it was James A. Baker III, who was the Treasury Secretary at the time, was speaking, I want to say in Berlin or somewhere in Germany, and he said, well, we're not going to intervene and support the dollar. And that led to the cascading that was like the straw that broke the camel's back, and then everything broke. Bonds sold off big, and then the market, opened lower, and then that was Black Monday, so to speak. So to me, it all comes down to like, what are you prepared to do behaviorally? So you have to look at the chart as you're having a conversation with the instrument, with the market for that particular instrument, and the instrument is communicating to you, here's where the price is, here's where the volume is on any particular day, here's what the average volume is, here's how people have behaved at key inflection points, new highs and new lows and this and that. And so then you have to figure out, just like you would with any other human being, how are you going to approach that person and start a conversation? That's how I look at it. It's all human interaction, right? Because to me, it's like you have to look at, you're trading and you can go look this episode up. It's on the channel. Are you trading the chart or are you trading the crowd, right? And on some level, I understand that they both can be somewhat similar, but it's the crowd, the human beings that have the intentions, right? And intentions equal results. Behavior predicts where you end up. So I'm more concerned with how the people are going to trade the chart more than the chart itself, right? Because the chart in and of itself is just a reflection of human beings' behavior. Who bought what at what price for that particular day or that particular time frame? Put it down. It all comes from the exchange, that data, so it's legit. And there you have it. So when you think about your trading, that's why self-knowledge is so important, because when you start to figure this stuff out, that it's not you, it's me, you're right, it is you, right? It's not the chart really, it's how did you trade it? Did you want to watch the chart and not put any alerts in because you're going to wait and see? Because when you do the wait and see thing, you both miss at the same time you have enormous opportunity cost, because the markets will move away from you faster than you can get in. That can lead you to chasing, or if you're having regrets and strong emotions, and then you're full of indecision, like, should I get in here? I don't want to buy it at the top. It's going to pull back. My holding period's too short anyway. The truth is you missed the trade. You got to take it off your screen. You missed it. You blew it. You fucked it up, basically. That's the way it goes. And I don't mean to put a stick in your eye, but that's when you learn, like, okay, I have to take these alerts seriously, or even better, I need to have the conviction enough to put my buy stop in and add risk. And if you feel fear, you have to go back to what your goals are and say, okay, well, why do I feel fear when I'm going to add risk with a vehicle or in a vehicle that could bring me financial abundance? Right? Why do I have these strong feelings? Am I not worth it? Right? Is my self-esteem like, do I not need it? Or I can only make so much and then I have to get out because it's too painful to make a 5-hour trade. I have to stay at 2. That's just who I am as a person. I'm always going to be beta. That's your call. I don't know. I try to help people through this every day. And for the life of me, I don't understand why they get comfortable taking small gains for all the work that they're willing to do. Like, if you're doing the work, you deserve to get paid. It's not even a question at that point. You deserve to get paid. It's your birthright at that point. You're taking risk. You deserve to get the returns. At the end of the day, there will be losing periods, and that kind of goes with it. And as I've said, if you know what your numbers are, you can kind of predict the frequency or the probability of a certain losing streak of end losing trades. You can figure out what's the probability of having a 6-trade losing streak. So that's all stuff that you can know ahead of time, again, and calibrate your system for better understanding the results of your behavior, because it doesn't say anything about you and any of your intelligence, or lack thereof. It's pretty simple. You add risk and you remove risk. To me, intelligence is everything else. It really doesn't. It's not at play here. So be very, very careful about what you hear other people say that you automatically adopt as your own ethos without having any proof. And I know in religion, right, what are you but for your faith? But this is something different, because now this is tangible. This is stuff that you can do. You can put money to work, make money in the market, and withdraw that money and buy other assets. And that is a bona fide process that you can do every day. I know you can do this, but you have to study yourself. You have to study your own behavior, and you have to understand how you feel, because it's all emotional. How do you feel about adding risk? What do you feel like when you have to manage the risk that you're in that you just added? And then how do you feel when you remove that risk? What comes up for you? Are you still anxious? Are you mad at yourself? Did you turn into your devouring mom or your overbearing dad, right? Like, where does that? It all comes from your environment and how you grew up. Same for me. It's no dig on your folks. It's not the point. We're all products of our environment and the stuff that we see every day. And we take that in, and it falls into our subconscious and becomes learned behavior. So sometimes you could be acting out stuff and you don't even know where it's coming from. Well, it came from your upbringing somehow. You saw somebody demonstrate a certain type of behavior when they were taking on risk. You might have heard people say, really stupid things like, you can't trade in the stock market. Like, you can't even buy blue chip stuff because it's legalized gambling. And we're not gamblers. But in the meantime, they're spending $100 a week on those scratchers where you have no chance in ever making money, or they're playing a Powerball in a lottery again, where you have like a 1 in 12 million chance and they do nothing but give their money away, as opposed to even doing something like a $1 or $200 a month, S&P 500 investment, dollar cost averaging. So it's hard when you were getting mixed emotions or mixed signals like that, because everybody, parents, siblings, aunts and uncles, grandparents, they all have biases. And it's our job as risk managers to uncover where our thoughts come from. Like, why do these beliefs are so important to you? You're not betraying people if you challenge. You don't have to challenge them to their face, but you're not being a disloyal person if you challenge the things that you were taught by the people that were closest to you. They very well might have been amazing human beings. They just could be completely ignorant on the concept of how to manage risk. And then that becomes problematic, because if you grew up in that type of an environment, you might find yourself second-guessing yourself, even though you might have really, really good instincts. That's why I say try to do some experimentation, but do so with small amounts of risk, because you're not going to know until you try. I know you can do this. I've seen some really, I don't want to say it this way. Well, I'll say it this way. I've seen some pretty dumb people make a lot of money. Why? Well, because they could stay out of their own way. They just knew, like, okay, it's a game of taking chances. I've got to put the risk on. And if I put the risk on and stay out of my own way and the things are going to move, I'll manage the risk while the trade's on. And that's it. And I'm not going to overthink stuff. I'm not going to start reworking my model when the risk, how many times you do that? You add a piece of risk on in your portfolio, then all of a sudden you need to see the chart in 17 different time frames, as if those data points actually matter. You have to be hyper vigilant now, right? And I'm sure there's archetypes for that, right? People who are adopted are hyper vigilant. They tend to be more hyper vigilant. Again, I'm not a psychologist, but I do nothing but read. When I put my alerts in and my protective stops, I go read. I get to feed my brain, right? You can do the same thing. Download the audiobook of The Inner Voice of Trading. The link is in the description. And while you're bored this weekend, look at these videos here. I'll see you Monday.